you everyone for joining. My name is Stephanie Baxter. I am the Director of Programming and Engagement at the New Hampshire Tech Alliance. For those who aren't familiar with the Alliance, we are a technology association in New Hampshire. We work on growing and engaging the tech ecosystem and featuring all of the great innovation coming out of New Hampshire. So we do it by offering programs like this that you're seeing today. We have quite a few similar programs, different topic areas on our YouTube channel, hope you can check out. Throughout the year, we host different events from our Speed Venture Summit, which is basically speed dating for startups and investors, Product of the Year, and our Innovation Summit, which just happened recently as well. So we help our members. We focus on workforce and advocacy and policy and providing engagement opportunities. So we're so excited you could all join us today. We would like to thank Yorkie for sponsoring and bringing this content to us today. I think it's going to be a great topic here. As a reminder, the event is recorded and will be available on our YouTube channel after the event. So Janelle will do her presentation and there'll be time for Q&A at the end. And Janelle is the Chief Financial Officer at Yorkie. And if you're not familiar with Yorkie, they're a company, their vision is to reshape the way startups are built and scaled and monetized. And they're an extension of the startup team to help build a good company and not just a fast exit. So today, Janelle will walk us through how startups should navigate the complexity of back office finances so businesses can be set up for success. And I'd now like to welcome Janelle.
Thanks so much, Stephanie. Appreciate the opportunity to work with the Tech Alliance on this and be connected to folks out there who are tuning in. So thanks for taking your lunch hour. I know nobody else has their camera on, so hopefully you're enjoying like a good sandwich while we talk about finance. There's nothing that pairs quite as well, right? It's lunch and finance. Oh, hey, how's it going? So here we'll talk about financial planning and modeling for startups. Although I've kind of broken it out today, I'll do a quick intro and then talk a little bit about accounting basics and then kind of jump into financial modeling. Let's see. So by way of a brief introduction, I am Janelle Gorman, Chief Financial Officer at Yorkie here in Manchester, New Hampshire, graduate of University of New Hampshire in Durham, lovely school. And after that, I kind of followed the typical accounting graduate route in public accounting, worked with Baker Newman Noyes, got the CPA license, a few years of public accounting under my belt, and then joined the team at Dine, which is also here in Manchester, a really high growth company with a very exciting growth path and ultimately an exit to Oracle. After which I spent some time at TRM Microwave, which is in Bedford, a little bit of a different industry. They are in the radio frequency microwave component space for defense and aerospace industries, but also a period of high growth, and ultimately sold that to private equity just about a year ago. That kind of all led me back here to work with some folks that I was at Dine and Oracle with here at Yorkie, which is really exciting to be back kind of with my old team. You might hear some of them in the background. They're kind of loud behind me here. So Yorkie is a vertically integrated strategic growth and investment firm, as Stephanie mentioned, helping to reshape the way companies are built, scaled, and monetized. And there's kind of three pillars of how we look at that. We are an investments firm focusing on companies in the B2B SaaS space. We have over $28 million of capital invested with over 100 firms. We have created and launched a Fuel platform, which is a SaaS-based strategic growth platform, a really great resource for market intelligence and data, but also some advisory resources, templates, articles, blogs, and also some lectures similar to what we're talking about today. And then we have our hands-on advisory services. So we have over 45 clients that we're helping with marketing and communication, financial operations and capital strategy, product and market. We have several modules of service and a couple more coming in 2022. So stay tuned for that. Really an exciting place to be. And we really are all hands on deck, partnering with the startups that we invest in and some that we don't, to really help kind of a rising tide raise all boats and help to see entrepreneurs be really successful in what they're venturing out to do. So as we kind of jump into the topic of today, I know I didn't advertise accounting basics as part of this webinar. I might have lost some attendees if I had, but I want to just kind of start with what are the basics of accounting data and operations that you want to make sure you have in place before you start to build and look at financial forecasting and modeling. Every house is built on a strong foundation, so we want to start there. So we really here talk about kind of nailing the basics and basic accounting tasks. I'm really talking about like bookkeeping, tax compliance, and some level of reporting. Those are all critical to the business. And the data derived from accurate financial records is incredibly valuable and useful for strategic planning, strategic plan execution, and then ultimately growth. So kind of looking at these two pictures, we have here a couple sand castles. The one on the left is like, not even really fit for a crab to live in, right? This kind of represents financial data that's late, incomplete, disorganized, misclassified, choppy. This is often what you might see if you have a really reactive financial operations or no financial operations, where you're just kind of writing checks as bills come due and hoping that the bank balance at the end of the month is enough to get you through another month. Really not a great place to be and not a good foundation to build a growing business off of. To the right, you see a sandcastle for like a princess mermaid. This is data that is consistent, comparable, accurate, timely, efficient, and effective, two of my favorite words, and reliable. One thing to note is the structure on the right here is like windows and bridges and is really complex. That's not the point. You can have a really good set of financial information that's really basic. The point here is that it's well-founded, it's consistent, you have good records, even to the extent of like your invoices are alphabetized and maybe kept digitally rather than in a pile of paper and shoved in the corner. Those are the things we're talking about when we're talking about really great financial records and accurate financial information. This gets a little accounting-y, so hang on with me here, but I wanted to talk about a couple of terms that are really important. The first is generally accepted accounting principles, or you might hear this referred to as GAAP accounting. This is a common set of accounting principles, standards, and procedures issued that all public companies in the US are required to abide by. They help to ensure consistency and accuracy in accounting reports, and kind of think of it too as like apples to apples between many companies. You want to make sure they're following the same rules in the financial data that they present. Those are established by the Financial Accounting Standard Board, or FASB. And FASB does also interpret them for private companies and not-for-profit as well, organizations as well that follow GAAP. One of the key points that I want to make about GAAP accounting is that it requires the accrual accounting methodology. So a lot of early stage businesses and small businesses might follow the cash basis accounting methodology. It can be kind of a faster, streamlined kind of shortcut to get your accounting books right. And that's really just, you follow cash, right? So when cash goes out the door, you incur an expense. Cash comes in the door, you've got yourself revenue. Accrual accounting really tries to match your financial records to when revenue is earned and when expenses are incurred. So for example, if you pay for a trade show booth today, but the trade show isn't until March, cash basis accounting would say that you have an expense today when the check goes out the door. Accrual accounting would say it's not an expense until you actually incur that expense. We work with a lot of B2B SaaS companies and they're subscription based. So this becomes especially important around revenue. If you have a customer that pays for their subscription annually in advance, you would get the cash today. Accrual accounting says you got the cash today, but your revenue is earned over a year as you deliver those services. That's really where one of the most important delineations comes into play for accrual accounting. The takeaway from this slide here is that understanding and applying GAAP is one of many foundational elements that will enable your company to scale. You want to start here with the basics and mature over time alongside the company's growth, as well as you start to work with more sophisticated investors and bankers, and they require some more robust financial reporting. But the takeaway really is to engage a qualified accountant early. They may be an employee, they may be a consultant, but you want to establish accounting practices and policies that are in line with accrual accounting and GAAP accounting, even at the most basic level, and they'll become more robust over time as they need to be. So here's just kind of an example, a scenario, if you will, of why it's important really to nail the basics and get those accounting practices and policies in place early. So in this scenario, we have a very successful company with huge growth in revenue. There's hiring and spend all to follow along with that. The board of directors here sets very aggressive but achievable goals. And the finance team really is keeping up as best as they can with this growth, but they're reactive rather than proactive. So the problem in that scenario is that the accounting systems and procedures weren't purposely set up as a solid growth foundation. So accrual periods were not well documented by month. So maybe they got the year right, but in my earlier example, was the expense actually in December, or was it in March when the trade show was attended? Or was the revenue actually earned in December, or was it earned January through March for a Q1 contract? Expense classifications weren't broken out. And when we talk about expense classifications, we're talking about cost of goods sold, which gets you your gross margin analysis, research and development, selling and marketing, and general and administrative expenses. How you allocate your spending over time tells a story that investors will be very interested to hear, especially as you get further in your growth. And then the problem here too is the detailed analysis and metrics required for growth weren't accurate because the underlying data was messy. So the solution here was, well, this company is really growing and the board wants certain levels of reports, and so do the investors. So let's reopen the books. And that was to review past transactions and reallocate expenses to the appropriate classification so you could actually get accurate metrics to tell the story of how the company grew and where it was investing its capital. And then also review expenses for cutoff by month and book adjustments within the period that they were incurred. I mentioned earlier, even keeping your invoices electronic and alphabetical makes a big difference. In this scenario, the accounting team had to go to a storage unit and open up banker boxes to try to find invoices. It really takes a ton of time. So even just something so simple as nailing the basics to keep electronic records can be really impactful. So the cost here, the months of consolidated work, just true focused effort, but it established a pattern of reactive accounting practices rather than proactive, which then streamlined into inefficiencies and stress for all parties involved, including the management team that wanted to consume the data. Some high audit and tax fees because the engagements would run longer because the accounting records weren't super clean and documents weren't so easily to make available. So all that to say, at the end of the day, in this scenario, everything was fine, but you can avoid a lot of work down the line. One of my favorite quotes here by John Wooden is, if you don't have time to do it right, when will you have time to do it over? And that's so true for startup world, where you think, after this, I'll have more time. And after, just get through this thing and then we won't be so busy. It's kind of never true in high growth. You're always going to be really busy. So best to nail the basics up front. So as we talk about those foundational accounting practices, I kind of break it up into three groupings. The first is accounting policies. So these are internal guidelines that define how your company will treat specific financial transactions, largely like a revenue policy, right? So what products do you sell and how do you treat revenue? How do you recognize revenue for each of the sales transactions you may be involved in? Capitalization policy speaks to when do you capitalize fixed assets or capital equipment versus expense it, so on and so forth. So saying, here's how we're going to treat these broad types of transactions will set you off for good, comparable treatment and kind of streamline the process down the line. Accounting procedures are internal guidelines that document how the finance team goes about their work. So this is a little bit more specific. This is, how do you do your monthly close? So what are the steps that you go through to make sure that at the end of the month, your books are properly stated and your basic financial statements are accurate? How do you go about recording banking transactions? How do you analyze AP, AR? This also helps in times of high turnover. If you have well-documented accounting procedures, you can replace an accountant easier if you lose someone, or if you have an outsourced accountant and you need to use a new firm, having well-documented accounting procedures helps you to bring in that new firm easier, a little bit more streamlined, and save time in that transition process. And then internal controls can be a challenge for startups and small businesses, but they're incredibly important. Even if you're a team of 3, internal controls are policies in place that promote accuracy, improve reliability of financial data, and reduce risk, especially as it relates to cash. So for example, segregation of duties, cash access. So who has access to the bank account, who can sign checks, and is the person that can sign checks different from the person that might review the bank statement at the end of the month? Spend authorization, who has a credit card. So even with only 3 people, you can still have segregation of duties and some review processes in place that provide a little bit of assurance to reduce risk and improve reliability of your records. So as we kind of think about these basic accounting tasks, there's kind of a who, what, and when, right? Like, okay, so I have my business, when do I actually have to do these things? So for bookkeeping, this is really what people think of as your standard like accounting stuff. Accounts payable, accounts receivable, payroll, cash transactions, some operational tasks. A lot of times we'll see this go to an outsourced firm, which is perfectly fine and can be really cost effective because in a simple business structure, it doesn't take a ton of time. But if you bring it in-house, it's probably a specialist or a lower level employee, someone earlier in their career. And you're going to want to get that right from day one. And so that's not to say that you need to overdo it, but as soon as transactions are running through your business, you want to make sure that they're being properly recorded and that the documents are being well retained and easily accessible. Tax and compliance relates to tax filings, tax schedules, any correspondence with the IRS or any other taxing agency, reconciliations, and then tax planning support. This is very often outsourced. So most of the time people will have a tax accountant that they engage for their filings at the end of the year. You also need somebody internally that's going to work alongside those tax accountants to provide them the information they need in order to make accurate filings. That often is your accounting manager. If you have a great bookkeeper or accounting specialist, they can also serve in that regard. And you're going to want to get that right in the first year. So basically, as soon as your first tax filing deadline comes up, you want to make sure that that's accurate. So it's good to start early, but by your first deadline for tax filings, you want to make sure that you have a good structure and team in place to meet those needs. And then reporting, this is where what we will talk about, I promise, as advertised, is kind of your forecasting, budget to actual analysis, cash projections, and basic financial statements. This often can be an outsourced firm. Most times it can be the same outsourced firm as your bookkeeper. They'll typically continue that work if you want them to kind of go upstream for some reporting. If you have it in-house, it's probably a controller that's doing some of that. That might be like further down in your growth. You want to do this as soon as practical, certainly after your pre-seed round. And that's to say that kind of depends on the investors that you're looking at, or if you're working with banks or a startup lender, what they require for financial reporting. But certainly as you continue to mature, the investors that you go out to seek will require more and more robust financial statements and analysis. And certainly as you get into a period of super high growth, that's where your forecasting will really come into play. So speaking of forecasting, as promised, forecasting is incredibly important, as we said, for high growth companies. And that's because high growth companies are intentionally walking a really tight line between high growth and maintaining a healthy company. You don't, as a startup, want to sit on a big pile of cash or be earning a huge net income if your purpose is to grow. You want to be reinvesting that cash, reinvesting those earnings to continue to accelerate your growth. In order to do that and maintain a healthy business, forecasting becomes critical. So let's talk more about that. Financial modeling is a representation of financial outcomes experienced or expected to be experienced. So that is to say that you can have a historic financial model. I've often seen a historic financial model be used when the lens you need to look at your finances now is different than how you had looked at them in the past. So maybe to say, like, you didn't really break things down into R&D general and administrative and selling and marketing from cost of goods sold in the past, and you want to go back and have a look at what those trends really do look like for history. So you can have a backward-looking financial model. What we'll talk about more today is a forward-looking financial model, outcomes expected to be experienced. And those are based on a set of business decisions, operational inputs, and predictive metrics. So financial modeling is hugely valuable. It drives reliable insights, progress on your strategic growth. It enables the identification of constraints and opportunities. It enables trend analysis, which is incredibly important and tells your story over time. One set of financial information at a point in time is great, but if you're trying to tell a story, especially about growth and especially to new investors, to say, here's how I've come so far, here's where I expect to go if you choose to invest in my company, that trend analysis is incredibly important. But financial modeling will also enable data-driven decision-making. So it kind of takes the feelings out of decision-making a bit, which is incredibly valuable in a business. And then it also promotes predictability, accountability, and measured success. So if you get to the end of the year and you say, did we have a good year, yes or no? Well, what are the metrics that you can use to be really data-driven about that, rather than just say, well, it felt like a good year, it seemed exciting. How do we know for sure? And keep that judgment consistent between individuals who might have a different emotional perspective of the year. So why forecast? So imagine that I kind of said, okay, go pack a bag, I'm sending you on a trip, and you knew nothing about what you were going to be doing. In that case, you might overpack, but yet underpack at the same time, right? You don't use half of the stuff you have, but you have like hundreds of bags. You might have fun, but then learn, oh, it was a business trip and you actually missed the meeting. So you didn't get accomplished what you should have. And you took a $1,200 flight, you stopped twice, but oh, you actually could have driven for much less. If I told you you were going on a trip and gave you all the details of where you were going, what you needed to accomplish, you could be much more accurate and efficient with your trip. You grab a carry-on only, knock out all your work in the morning, enjoy lunch in the city, and then make it a day trip, sleep in your own bed, save all the budget to do 3 more trips just like it. A pretty simple example, right? But of course, you want to be the person there rolling with 1 bag only. And of course, this analogy plays right into business, right? So if you're running ad hoc, then that overpacking and underpacking is a misallocation of resources and wasted cycles. You want to be really targeted in what you're doing and what you need to get it done so you waste nothing. And resources could be time and money. If you're running ad hoc, you could have misaligned goals. Success looks like one thing to somebody and another thing to somebody else. This aligns to the example of missing the meeting, right, when you're on that trip. And also the horrible trap of best effort targets. So if your goal in running ad hoc is let's do the best we can, you're not going to get where you need to be across the board. Some people might think you made it, other people might think you fell short, and it's hard to measure. Running ad hoc also sometimes traps you into a status quo. You don't know if what you're doing is working or not, so you don't change it. And we know in a high growth company, change can be really good and status quo can be dangerous. You also may tend to patch solutions over problems. And so you just say, well, let's put this on top, or let's add this system, or let's hire 1 more person. You end up in a work harder, not smarter cycle, which is not good. You could have redundancy or unproductive effort where 2 people are doing the same thing, or a portion of what they're doing is overlapping, or someone's doing it like so the hard way, but no one was really paying attention and it could have been done in half the time. With a forecasted plan, you nail that resource efficiency. And then with that acceleration, if you know exactly where you're going and how to get there, you can get there faster. Aligned expectations and accountability to say, did we meet the target? The metric was supposed to be this. What is the metric? Does it meet or not, and why? A forecasted plan can also enable you to have timely pivots. So we know in a high growth company, what you thought might happen 12 months ago is very rarely what actually happens in the next 12 months. So those pivots are incredibly important. Even in today's hiring market, we see pivots based on a great candidate came and you weren't going to hire that role 6 for another 6 months, but the candidate's here and they're ready to roll. That pivot might be really important. And if you have a forecasted plan, you can understand if you can actually take them on early or not. Solutions, eliminating the problem, right? So instead of adding a new system, you actually realize you can take these 3 systems and consolidate it into one, or these processes or whatever it may be. So eliminating the problem rather than just covering it up. Effectiveness, and then as I've mentioned a few times, because it's my favorite thing, data-driven decisions. So we talk about budgets versus forecast. The words they are 2 different things. They can be used sometimes as the same. So I just want to talk about what's the difference. A budget is a financial plan that reflects the results of the strategic plan if executed properly over the fiscal year. It's generated before the start of the fiscal year and typically remains static. Sometimes people will update their budget periodically, but generally it's a static measure. And it's used as a tool to measure success against your strategic plan, and it facilitates accountability for financial results. The problem with a budget is that it is very stringent and static. And in a world of high growth, it simply just doesn't, the story that it tells starts to become untrue by the end of the year. So what I tend to use as a forecast, which is a rolling forecast. And I call the other thing with the budget too, I want to mention is people sometimes can look at a budget and say, this is exactly how much I'm supposed to spend, right? You don't want to be over budget and you don't want to be under budget. And so it incentivizes behaviors in a way that might not be most beneficial to the company. So while I do make a budget, and I kind of call it my fixed forecast because I always want to have something to compare back to, I also keep a rolling forecast. And that's a financial tool that reflects real-time estimates of financial results based on dynamic execution of a strategic plan. It's dynamic throughout the year, typically updated monthly or at least quarterly. I update mine monthly. And it is often maintained for a 12-month rolling period. So if you're a calendar fiscal year, your budget might be January 1 through December 31st, but your forecast will always roll 12 months out. So you have a 12-month picture ongoing. That rolling forecast can be used as a tool to guide business operations and dynamic strategic decisions. This could include scenario analysis, M&A decisions, whether it be on the buy or sell side, pricing strategies, so increases, decreases, or changes in how you price, optimal product mix, so what are you really going for to try to sell? Well, how does the business do if we sell more product A versus B or B versus A? And then, of course, response to unforeseen external factors. For example, a global pandemic. You might want to have a flexible forecast to say what's changed now in the world that may have been out of our control. So where to begin when you're going to be making a forecast? First, you want to understand the financial objectives set out in your strategic plan. And that's to say that you have a strategic plan. So I guess the even pre-step is to have a strategic plan. And that's to have some idea of where do you want to be in the next 3 to 5 years? What steps can you take in the next 1 to 3 years to get you there? And then break that down into 6 to 12 months, 3 to 6 months, and then 0 to 3 months. So you'll have that plan throughout your business, product, marketing, selling, G&A. But what are the financial objectives that are buried within that and laced throughout that strategic plan? Identify those. And then select a few key metrics to track that are really relevant to your business that will tell the story of success and make sure that for these key metrics, if you nail them, it means you were successful. If you miss them, it means you have a problem, not just the shiny ones or the ones that look good at the moment, right? So you want to say, like, these are really the critical ones that tell me the financial health of my company and the success of my strategic growth as I've intended it to be. I've read somewhere, I mean, there's dozens of key metrics, but I read recently in an article that investors are really looking at like 8 to 10 metrics, and they're not always the same. You want them to be specific to your business. And then to the extent that you have it, you want to understand your historical financial performance. I know startups often don't have historical financial performance, but in that case, you might take a look at the industry that you're taking on and try to understand historical financial performance of your competitors or companies that are closely related to yours. I had a colleague once say, history will repeat itself unless something changes. In high growth companies, we know that things are always changing. So it's good to know history, then factor in what you're going to change about it, and then predict where that will land you. Second, you want to develop, these are kind of like the three critical forecast areas: your booking and revenue forecast, your expense forecast, and then your capital forecast. And capital forecast is to say like your cash runway. We'll talk about that a little bit more in a couple slides. Once you have those down, then you can expand to projections by function. So you can start to dive into your marketing team or your selling team or your R&D team and really get a little bit more granular with the projections you make for that spend and its impact on top line revenue. You can get into scenario planning like we talked about, and then you can start to create models aligned to specific strategic initiatives. So if you're going to do a big campaign, or if you're going to do a series of events this year and you hadn't done events in the past, or if you might introduce a new product. Oh, sorry, it's my watch talking to us. So popular types of financial models, and these all kind of play into your larger like forecasted income statement, but a quota model and compensation planning could have a commission plan in there, a hiring roadmap, sales team structure, quota carry, discretionary bonus plan. Booking and revenue model is going to be built, and we'll talk about this one a little bit more, from your pricing and packaging assumptions and model, your sales quota attainment, customer retention and new customer adoption, revenue recognition policies, and so on. And then, as we mentioned, for scenario planning, merger and acquisition model. So if we can acquire this company, what would that do to our bottom line revenue? What would it do to expense? Are employees coming over or not? Do we consolidate facilities or not? So on. Scenario planning for change in strategy, facility expansion planning, essentially anything that might be a strategic decision of the company. You should always kind of be doing that scenario planning through a financial model. One of the really important models, maybe even before an income statement model, if you're really as a new startup and not super well funded, is to understand your capital run rate and your burn rate analysis. So this basically is to say how much cash do you have and how long will it last you? As we talk about strategic planning, and financial forecasting, that's all well and good. But if your business can't survive to see to it that that strategic plans comes to fruition, then it kind of shows over. So you always want to make sure you're well funded enough to be able to get that runway in order to see your strategic plan come to fruition. So there's two ways to look at burn rate. Burn rate is how much cash are you spending in excess of the amount that you bring in. That's a net burn rate. There's also in this model a gross burn rate. That doesn't consider any cash coming in. And so I prefer to use net burn rate so long as your company generates steady revenue, especially under like a subscription model, or you generally have enough history that says you can expect a certain amount of cash to come in every month. If that expectation is reliable, you should use it in your burn rate analysis. If you're pre-revenue or really lumpy in how much cash you bring in at any given month, then you might want to look at gross burn rate. So like I said, we talked about burn rate being the excess of cash that you spend versus cash that you bring in. It's important to note that net burn rate is not the same as net income. So if you recall, just from the beginning of this presentation, this is especially true under the accrual method of accounting for revenue if your customer pays in advance. So if they pay today, but they have a 1-year subscription, you're going to take revenue over a year. So your net income is going to show up every month in the year from that revenue, but the cash has already been received. So really important to understand how cash flow might differ from net income. In some cases it doesn't, especially in like the real early startups. Their customers will pay a month at a time or whatever. And so if it lines up, that's fine, but just be aware if your business model doesn't have that aligned. Your cash runway is stated in terms of months, and that's how long can you operate at your current and projected burn rate before you run out of resources. This number of months is really important to understand, because at some point you're going to have to do something about a shortening runway. And so oftentimes we see it as fundraise planning, and that could be equity fundraising, or it could be seeking debt for financing. And that could be through a bank, through a line of credit, or even through like a startup lender. But you're going to want to leave yourself plenty of time to get that in place. Especially, I mean, if it's logical, it stands to reason, it's kind of logical. No one wants to lend somebody money that is desperate for it, especially like a traditional bank. So the earlier you can get like a line of credit or something in place, the better. And then also, if you go out for equity fundraising, that takes a good amount of time. So you want to leave yourself several months to get that work done. The alternative for a cash runway is to reduce expenses, but in a high growth company, there's often not much to reduce, right? Every expense and dollar that goes out the door is really well spent and very impactful. So you always want to understand your cash runway and get ahead of things so you can go the finance, the fundraising or debt route rather than expense reduction. The other model that I wanted to talk about briefly is the booking and revenue model. There's a lot of things that go into this. It can be really robust and really detailed and have like several tabs, right? Or it could be kind of back of the napkin math, but either way, the same concepts go into it. So first we think about pricing and packaging. So what is it that you're selling and how are you pricing it? You'll want to look at competitive data, perhaps a cost analysis of what you're selling, and then market intelligence. So understand who are your customers, what's your market that you're going for, what other players are in that space, what might your customers be willing to pay for this, especially for your differentiation or competitive advantage against your competitors as you develop your pricing and packaging. And there's two ways to kind of look at sales. There's like a lead conversion metric you can look at to say, what's your success by stage to close new deals? So if you say like, gosh, we really do a great job, if we can get a demo, we really do a great job at converting a demo into a closed won deal. Okay, so if you have X number of demos in a month, how many leads do you need in order to get that number of demos? And okay, if you can get this many leads, makes this many demos, makes this many closed won deals at an average selling price of X, you might be able to develop your booking and revenue model that way. The other way to look at it is from a quota carry perspective. So that's to say, how many salespeople do we have and what quota are they each given? And then as you budget booking and revenue, you want to be a little bit realistic, especially for ramp time, to say, okay, maybe they can reach 70% of their quota attainment. So if I have this many people at this certain quota at 70%, that might give you an understanding of bookings that they might attain throughout the year. The other perspective is to look at what customers you're bringing on. So new customers, existing customers might upsell to increase their scope or downgrade to decrease their scope and therefore their spend with you. And then as much as we all hate to admit it, churn, not every customer will stay on the platform or stay as a customer forever. So what do you know about churn? What assumptions can you make for how many customers you'll have and how that might change throughout the year? Once you have some of those inputs, you can start to create the model. And again, that can be really robust, or it can be kind of back of napkin for like, well, I think we can get 5 new customers a month and the average selling price is 10,000 a month. And so, you know, here we can grow kind of like 10% if we get a new head count. They can start to come together that way, or you can build them out really robust. It's up to you and how many resources you have and how interested you are to do that work. But here on the left, we kind of have a price list to say, let's say you have kind of 4 tiers of packages, and there you have a monthly price. You can use that as an input to the model then to wrap up with the rest of those assumptions to then come out with what you can assume for quarterly MRR, which stands for monthly recurring revenue, which is like a subscription-based concept, how many clients you'll have at any point in time and how much that will grow over the year. How your MRR changes, and then get an idea of your run rate. So your run rate is your monthly revenue times 12 to say, if your monthly revenue in Q4, you can see it's 529,000. If you retained that same base of customers at that same price, what would your 12-month revenue be? It's kind of a predictor. Once you have that information for booking and revenue, the leadership team can start to develop forecasts for the related expenses, including salary and benefits for how many salespeople do you need to have, how many marketing people do you need to have in order to generate the number of leads that it would take to get to this estimated output of customers. Marketing spend, so are you going to events, or are you doing SEO? Are you investing in demand generation in order to get these leads? Travel and entertainment, as I mentioned, like for events or sales calls. Consultants you may need to fill a really rapidly growing demand if headcount might not be the way to go. But then it also says you can start to infer other salary benefits and other costs. So in this example in Q4, you're up to 79 clients. So will you need more customer success representatives to properly onboard those 79 customers and maintain them as really successful and happy customers so that you're not facing churn and then a declining client count. So once you have this kind of in place with some assumptions on booking revenue and client count, you can start to infer some of the other expenses on your balance sheet, on your income statement, sorry. So final thoughts here, of course, nail the basics. We spent plenty of time on that, but even if you're not yet at the point where you're doing these robust forecasts and all of that, or you're not doing expense classification separation just yet, you might someday want to go back and do it. And if your financial records are really clean and accurately kept, your documentation is easy to find, you can always go back and pull out those details later on. So really important to nail the basics. You want to validate, first have a strategic plan, and then use a sound financial model to validate it. So if your strategic plan is to get from 100,000 in revenue to 10 million in revenue in 3 years, well, can you make a sound financial model that actually presents a feasible, possible, healthy way to get there? And so a good financial model kind of supports a strategic plan to say, yes, we have a path that we can actually do this. And so this strategic plan is valid, and here's the model that we'll try to use in order to get there. Once you have a model, be sure to use it. So you don't want this to be a one-time exercise and say, yep, strategic plan looks good. If we do all these things financially, it'll all work out. You want to use it to say, are we on track to actually achieve all of the things that we said we wanted to do in our strategic plan? Is the financial health of the company coming to fruition in the way that we thought it would? And if not, let's make a change. A simple model can be very effective. So we talked about some in-depth concepts, but I've also seen some clients that have a really very basic cash in, cash out monthly and a cash in, cash out forecast for the next 12 months. That can be very effective in early days. So start simple and make it more robust as that becomes useful for your business, especially in terms of capital runway, as we mentioned, and a basic income statement. If you have a rolling forecast, which I encourage you to, you want to maintain version control. You don't want to overwrite your data because, as we said, historic perspective is really valuable. You can use Excel for financial modeling. It actually can go a lot farther than you might think it could to be using financial modeling in Excel. I've seen really big companies still functioning in Excel. That being said, there are plenty of software solutions. Not all of them are super expensive. So whatever you feel comfortable using, go ahead and do it. Excel, if you love Excel like I do, that can last you quite a while. But don't feel intimidated by this. Start simple, use software if you need it, but definitely a good exercise for any high growth company to do. That's all I have for today. So I'm happy to take questions if anybody has some.
Thank you so much, Janelle. We'll give people a minute to pop in and ask a question. You can either put it in the chat or you can unmute directly. As a reminder, this content will be available after the event so that you can review all of those how-tos in further detail, really valuable information. So let's see here. So if anyone wants to unmute and ask a question, we'll just give it a minute, or you can drop it in the chat.
I'm also very easily found on LinkedIn and Twitter and all that too. So always appreciate a good outreach after the fact as well.
Perfect. Well, thank you, Janelle, for, oh, hold on. What are some, oh, you got a couple comments in here. What are some typical Excel model templates?
Yeah, so typically I've seen, I mean, it depends on what your business wants to use it for. Actually, in Fuel, as I mentioned, our Yorkie strategic growth platform, there is an advisory section, and financial operations has an advisory section that has a couple of templates on there for bookings, and also like a general income statement forecast that you could download. But a lot of times I see, like in super early stages, like I mentioned, really a cash in, cash out. And that can be like simple line items in Excel to say, here's all the bills that we know we have every month and an estimate of how much cash will go out based on those bills and an estimate of cash in, and just rolling that forward where you have actuals by month for the time that you've experienced. And then you have a certain number of periods. I recommend 12, but you don't have to do 12 of forecast alongside. And so you might say some of them, I expect this to remain flat. And so you just kind of drag that number over. Or you might have others like headcount where you say, I expect to hire 2 new people. And so you kind of pop those numbers in.
Perfect. So just some thank you comments in the chat, valuable information. So we will wrap it up here if there's nothing else. Thank you again to Janelle and Yorkie for this great content today. And be sure we'll send out the recording and also be on our YouTube channel. So thank you so much.
Well, thanks so much, Stephanie. And thanks everyone for taking your lunch hour.